what's good money. Apart from those characteristics, maybe physical characteristics of gold, which we happen to like at Monetary Metals, there's also what makes good money is money that's not tinkered with by treasury officials in any country or by central bank officials.
Welcome to the Gold Exchange Podcast, where we untangle market and policy complexity using timeless economic principles. For show notes and archives, go to goldexchangepodcast.com.
Welcome back to the Gold Exchange Podcast. My name is Benjamin Adelstein. I'm joined by the General Counsel of Monetary Metals, Jeff Deist. Jeff, how are you doing today?
Good afternoon, Ben. I'm doing great. How are you?
Jeff, I want you to talk with me a little bit about what you think the difference between good money is and bad money, or just maybe even neutral money.
It's interesting we talk about this. We use the term good money, and I think we should, because there could be degrees of moneyness amongst currencies, amongst types of money that make one, let's say, a high-end luxury car and one a Yugo, right? In other words, there can be degrees of moneyness and there can be varying qualities of money. And I think most of us would say that we'd rather hold Swiss francs than Argentine pesos at the moment, for example, right? I mean, we always understand that money can be good or bad, better or worse. And what we essentially mean by that, of course, from the holder of the money's perspective, is does it maintain its purchasing power, or even ideally appreciate a little bit with respect to its purchasing power against real goods and services? That's what we'd like out of our money, I think, most of us. Now, there are other qualities. We've all read some basic economics and understand the portability and divisibility and durability and some of these other qualities that make money good or better anyway. But I do push back against the idea that any kind of money, and I'll even include gold and silver in this, has intrinsic value. Nothing has intrinsic value. Human beings imbue money with value. If I'm stuck alone in the middle of a desert, I'd rather have a gallon of water than all the gold in the world, right? So in that particular circumstance, I don't have much subjective value or utility for gold. But in my present circumstances, I would love to be gifted with all the gold in the world. So it's always a subjective matter. So we have to understand that that's really a key to understanding money. Fiat money has subjective value. Gold, Bitcoin, they all have subjective value assigned to them by humans. None of us acting alone can create that market or force anyone to accept anything. I think if we want to understand in the political context what makes for good money, I think we have to go to this concept of stock to flow ratio. In other words, while the money supply per se, I think, is a bit of a misguiding term, it doesn't really help us understand the world. Rothbard said, hey, it doesn't really matter what the money supply is because prices will just adjust. What matters is if central banks or treasuries are mucking about with the money supply and changing it abruptly or quickly in ways that the market can't catch up to, or that benefit certain, let's say we say, favored constituencies who get that new money sooner in the process. But stock to flow basically means how much of a certain currency or form of money exists, and then how much new currency or that form of money comes online, let's say each 12-month period. And as we know, in the past couple of years, especially since COVID, the supply of US dollars, both actual physical currency and more importantly, the electronic form, has risen, dramatically faster than, in my opinion, the demand for them. Whereas with a physical precious metal form of money like gold, you have to go out and mine it. You have to pull it out of the ground. And what we've seen historically, even when the market price of gold rises very quickly, and let's say gold as a commodity, as apart from its moneyness, when in history we've seen that when the price goes way up, a bunch of people immediately start putting capital into mining because they'd like to get in on that action and produce some gold. But it's really difficult to marshal the physical capital resources to increase the supply of gold, physical gold on Earth, any more than, let's say, about 2% in a given year. And that's when people really get into mining intensively because they see the price of gold going up, or they project that it's going to go up rapidly, and thus mining will be profitable with all the costs of water and diesel and labor and all the other things that go into mining. So really, what makes money good is, of course, its value, and that is subjective. But there are some objective criteria, especially the stock to flow ratio and some of those other properties that make some money better and some money worse.
I think one way that I usually think about this is, there's this quantity theory of money, and people talk, oh, well, how many dollars out there? And we've, made or borrowed or printed, whatever they want to say, more dollars in the last, year than we have since 1970 or whatever it may be. And, obviously that matters in some way, but in other ways, it doesn't really affect the dollar compared to maybe other currencies. Maybe it does affect the dollar compared to, the dollar price of gold or gold priced in dollars. But one way I think about it too is that if you're thinking of money as a commodity, the same way you think of it as shoes or commodity or cars or commodity, that explains the mining aspect where someone says, hey, listen, it's just really not profitable right now to go into the ground to get more oil because the oil price is, let's say, $100 a barrel and it would cost me 150 to go get that oil. You can think of money or gold or whatever your commodity is in the same way. It might not be the case that it is worthwhile for a miner to go into the ground and grab those resources like oil and labor and supplies and digging equipment to get more gold out of the ground. And until the market actually demands more gold or more money, it won't be made. And so there's kind of a market or voluntary signal from people saying, hey, we want more of this commodity, the same way people say, hey, we want more shoes. Versus with a more politicized money, which is, maybe a tool of governments, governments can say, hey, you know what, we want more spending in healthcare, or we want more spending on a Green New Deal. And so they'll say, hey, let's just create more of these, government currencies or government credits, and we'll kind of siphon them or funnel them to where we politically see fit. And oftentimes that political aspect of money is not seen, and also the kind of unseen consequences of that on interest rates, on market actors is sometimes not really discussed. Where it just says, hey, we can make more of this currency, which is true, but to what end and with what in the background happening, I think makes a question of, is this actually a good money and for who? Because for most voluntary transactions, like, hey, I want a new pair of sneakers, clearly you're providing value. That's why someone's exchanging with you, right? Exchanges only happen when there's value on both sides. Versus in a political money, that's obviously more of a bureaucratic decision to say, hey, the bureaucracy, have decided we want more engineers or more infrastructure or more healthcare spending. So the question is, what is good money, but also what is good money for who and for what purpose?
Well, it's very difficult to know how much money there should be. That should not be a political question. When it comes to the supply of US dollars between the Treasury and the Fed, we are every bit as bureaucratic, every bit as statist as the former Soviet Union was when it came to how many bushels of wheat should be produced by Soviet farmers, or what should the price of a Trabant be, an East European car. So unfortunately, we don't have a market in money, and nobody can know how much money there should be. No human or group of humans has that ability, and we all understand the concept of dispersed knowledge. We've all read our Hayek. And we all understand the price signal information that the market provides. And that's how somebody like Nike can actually use the market signals and profit and loss to figure out how many new shoes to produce in a given year. And then they take that risk. If they don't sell, they'll have to, cut the price or whatever they do. But money doesn't work that way. And we all understand that. But, this idea of the quantity theory of money, that if we want more of something, we have to create more money because the market's growing and the population is growing, or demand to hold dollars is growing. I mean, this is all pretty shaky stuff. And we tend to assign the quantity theory of money to the monetarists like Milton Friedman and Anna Schwartz, to the Chicago School, where Friedman was, of course, and we view it as almost this kind of mid-20th century concept. But it's been around longer than that. If you can go back and read Mises in 1912, The Theory of Money and Credit, and he was criticizing the quantity theory of money. He says, it's too mechanical. We can't know if, let's say, magically you could press a button tomorrow and the supply of US dollars, physical and electronic, within the United States alone, for the sake of our hypothetical here, were to double. It does not follow that all prices uniformly would exactly double in response to that. No, some people would hold on to this new higher balance in their checking account, let's say. They'd hold on to it more than others. Other people would run out and spend more of it. And of course, given what we know about the diminishing marginal utility of money, if all of a sudden people had twice as much, they might change what they buy. Instead of just buying basics like grocery or rent, they might go out and buy something fancy that they wouldn't have bought. And so fancy things, I don't know, jewelry or something might go up faster than staples like food and rent in that scenario. So just like the value of money is subjective, what people would go spend it on based on the quantity is also subjective. And I think one of the real tragedies, not just in the quantity theory of money in the monetarist school, but also in the broader, I would even assign this to the Keynesian or the neoclassical schools of economics, is that there's this disdain for people holding large cash balances, this idea that people could hoard money. We need money in circulation. We need to worry about the velocity of money. That's the famous V in MV equals PQ, So Keith Weiner talks about how there's always a fudge factor in that equation. If the numbers don't add up, you just change one of the variables. But this idea that hoarding money or that large money balances is somehow bad for the economy is just a terrible idea, because first it implies that a healthy economy is based on consumption rather than production. And I would say that that's quite the opposite, that production, creates the circumstances for us to consume. We all go out and work or do what we do to produce an income, and that's how we get our ability to consume things in the first place. That's Say's law, Jean-Baptiste Say, the famous Say's law. I mean, that's Say's law in a nutshell. But more importantly, if we look at this idea of hoarding or cash balances, which is oftentimes in the economic literature connected to or tied to this idea of money supply or the quantity theory of money. There's a British economist, W.H. Hutt, wrote this article in the 1950s. It was called The Yield from Money Held. And we say, well, what could possibly be the yield from money held other than maybe the simple interest we get at the bank? What do we yield from that? Well, again, it's subjective. If people are more uncertain, as they certainly were during COVID, for example, people were worried about, hey, am I going to lose my job? Is the economy going to shut down? Is travel going to shut down? Is dining out going to shut down? It was a very uneasy and uncertain time for people. So there is a natural human tendency to increase one's cash balances in that kind of time. It's like, hey, honey, COVID just hit. I don't know about our business. Maybe we should just hold on to that $10,000 that we were going to spend on a fancy vacation, right? I mean, that's human nature. We know that uncertainty tends to make people hold higher cash balances. So what that does is it creates a psychic benefit. In other words, people would rather have more cash, and the certainty that would bring, like knowing, let's say, hey, if in 3 months I lose my job, I will have that, several extra months of rent in my cash balance. And that gives me a better feeling inside. We can call that psychic profit, for lack of a better description. That makes me feel better than perhaps going on that vacation I mentioned. And so let's just hold off, right? That's the yield from money held. And what happens, different people have different subjective approaches to this. And what happens is that when some people hold more money, that actually benefits the economy in the sense that because that money is not being spent, generally speaking, that's deflationary with respect to prices. And so we want people to have some savings. We want people to be able to deal with a rainy day, the loss of a job, an unforeseen medical expense, whatever it might be. We want to encourage that, I think, from my perspective. And so this yield from money held is really, in a sense, this psychic benefit we get from this. It's really a refutation of this quantity theory of money, this consumption mania, that we have to get more money out there. And, if things heat up too much, says Milton Friedman, the monetarist, well, we just pull some of that back through monetary policy. We print fewer dollars the next year, or we stop printing so many this year. And of course, there's an uneasy analog here to modern monetary theory, which is generally viewed as more of a left-wing economic perspective, whereas Milton Friedman's generally viewed more on the right wing or free market side of things. But the monetarists the modern monetary theorists have the same sort of concept. Hey, let's just spend the money we need to spend, and if inflation starts to heat up too much, we'll just pull some of that money back through taxes. So all of this really goes to, I think, what is a very anti-human impulse. This idea that we need to use economic policy, so-called, where really we just need the market. We don't need policy from government. We need this economic policy to sort of steer humans to do this or that. And if they're saving too much, well, let's lower interest rates, maybe even into negative territory, as we saw in Europe, to sort of force them to get out there and spend, because that's what the economy needs. And we need to tinker with the money supply. That's what the quantity theory of money, and that's what the monetarist school suggests. And sometimes we just need to open the floodgates and stop worrying about spending altogether, because sovereign government has the unlimited ability to create more money at will. And there's just these sort of far away resource constraints, but we're not even close to that because there's all this slack, so-called, in the economy. That's what the modern monetary theorists say. So it all comes down to this same mania, this idea that more money is a panacea because it makes people spend. But the problem with all of this, Ben, is that more money in and of itself does not create a single new good or service. It does not in and of itself create any new economic activity. Prices just adjust. And I think when we talk about, hey, what's good money, apart from those characteristics, maybe physical characteristics of gold, which we happen to like at Monetary Metals, there's also what makes good money is money that's not tinkered with by treasury officials in any country or by central bank officials. And I'll finish with this. A couple of years ago, a good friend of mine named Rahim, who runs the Scholarium organization in Vienna, Austria, which is attempting to really bring the Austrian school back to Austria, which sounds ironic. He gave a talk about how, in the political sense of fiat currencies, nonetheless, a currency is really a nation's calling card. And I thought that was a really fascinating way to put it. What's good money? Well, we think in the former Zimbabwe, they had bad money. But, for many, many, many decades, the British pound sterling, wow, that was good money. Now, it may have been backed by some unholy elements of the British Empire and its military might and that sort of thing. But nonetheless, around the world, the British pound sterling was good money. That was accepted, that was known, and that was holding or increasing its value. The Swiss franc, we've often thought, wow, the Swiss franc. Now, there's a currency that you can be proud of and that anyone would like to exchange for, and that really holds its value. Even the Swiss franc has lost some of its luster, especially in the past 10 years since the Swiss government rolled over on bank privacy, and the Swiss central bank started buying FANG stocks and all kinds of other things on its balance sheet. Japanese yen. I know you've done some shows just in the past few weeks about, oh my gosh, we always think of the Japanese as very circumspect and fiscally responsible. Obviously, they've had some demographic problems and some debt problems relative to their national output, but nonetheless, all of a sudden, we finally see the terrible effects of that in the yen melting down. And you and I, Ben, happen to have the good fortune to be born in America, and so all of our lives, we have enjoyed this wonderful status of the U.S. dollar, the world's reserve currency, used everywhere, accepted nearly everywhere. It settles international trades across the board. It's used to buy oil from OPEC. We've got this big U.S. military, big bad organization. And, you and I have enjoyed enormous benefits from that through no merit on our own, just simply by an accident of birth. And the United States government's been able to export a lot of inflation to the rest of the world. And so we've enjoyed the status of the dollar as good money, in effect. Gold was always the best money, and we still think it is, but the dollar has been awfully good money for an awfully long time under the Bretton Woods system. And there's a real feeling that is starting to unwind. And I don't mean in the sense of the BRICS nation or, let's say, a rising gold-backed currency in the East or the Middle East or in Russia. What I mean is that I think the world is coming to sense that the US government is never going to get its fiscal house in order, that our bond debt is really junk bond status, that we are going to continue to spend wildly beyond tax revenues. And as a result, we are going to continue to print wildly. And we're just going to expect the rest of the world to accept that. And I think the coming out of COVID, the inflationary environment of the last couple of years has shocked a lot of people. And it's brought us back to a period that no one has felt since almost 50 years ago in the 70s. And that we're entering a new era of permanent, or at least in the foreseeable future, stubborn, enduring inflation that is at least 5%. It's probably closer to 10. I don't believe government statistics in this area. And that's a new reality. And I think that is shaking a lot of Americans to their core. They feel it, and they're looking for alternatives. And I think gold and silver, I think not just their price appreciation, but I think we're going to see them begin to decouple. As I said on a show with you a week or so ago, I think we're going to start to see them decouple from things like US GDP, US unemployment, US inflation rate. And I think we're going to see hopefully a slow, steady increase in those two precious metals. And as a result of that slow, steady increase, a renewed look at them for their moneyness elements. And that's really what monetary metals is all about. It's trying to restore some of the moneyness to physical precious metals.
Jeff, very interesting conversation about what is good money for those interested in learning more about what Monetary Metals is doing with gold and silver. Check out monetary-metals.com. Jeff, thanks so much.
Thank you, Ben.
This episode was brought to you by Monetary Metals. Monetary Metals is a different kind of gold company. Others buy and sell gold. Monetary Metals operates the Gold Yield Marketplace, a platform of products that offer a yield on gold paid in gold to investors and institutions, and are gold financing simplified, reliable financing denominated in gold with a built-in hedge for gold-using and gold-producing businesses. To learn more, visit www.monetary-metals.com.